Hello and welcome everyone to the May Policy Insights. I'm delighted to have here Neira Jones, who you all should know already because she's a fantastic trainer of all our courses and she looks after the new members and all the people who engaged with us from a regulatory perspective. And Neira is an independent consultant, a great expert of the payments industry, and last but not least, panel member at the payment system regulators. Neira, given your experience, thank you very much for agreeing to be here. And I have a few questions for you. Few difficult questions, but maybe you can give us a view in a very short time. What are the big problems in payments in the current state of play? And because payments is changing rapidly, where will be the major issues in the future?
Oh, that's a big question, and thank you for having me, Riccardo. That's a big question. I think perhaps we can classify them in two. The big issues in traditional payment systems and the big issues in forthcoming payment systems. So we have a very short time. So one thing I would say, centralized payments, we all know and love them. We know how they work. We know there are issues which we've been trying to resolve. Generally, that comes through regulations mainly, as well as industry initiatives. One example of that, for example, is authorized push payment fraud. Authorized push payment fraud started to appear in 2014. It's not until 2016 that we actually saw anything being done through the super complaint by Which UK, which is a Consumer Trades Association. And it's not until 2019-2020 that we started to see the contingent reimbursement model, or this voluntary code of conduct, as well as confirmation of pay. If we actually look back, did it work? Was it the silver bullet? No, it wasn't. In fact, less than 50% of victims of fraud got reimbursed. All in all, and people are still losing money. So why does it take so long? Well, regulatory cycles are very long, and criminals and fraudsters are very innovative in the way they try and find loopholes. So, but I think that the industry and regulations are moving in the right direction. Of course, contingent reimbursement is now being discussed, and we're looking at making more and more things mandatory and covering more and more of the ecosystem. But one thing that I was really pleased about, which happened recently regarding the contingent reimbursement model, is the Lending Standards Board. And I always thought that was a very big loophole that wasn't being addressed, has actually amended the contingent reimbursement model to require firms, banks, for example, or account servicing provider to identify new and existing accounts at higher risk of being used by criminals. What does that mean? In the current situation, we actually look at fraud and look at the payments and try to protect the individuals that are making the payments. But where they're making the payment is essentially a bank account that is held at a bank. And I've often wondered, why is it that those that service bank accounts, so mainly the banks, are not made accountable to actually look at those accounts receiving the money to try and identify whether this is fraudulent activity? Finally, this has happened. So the contingent reimbursement model has been amended, and this should be deployed by no later than December of this year. I think this will have an effect. And it's always the same thing with regulations and big things and big loopholes. It's a question of the regulation is there. Yeah, we may or may not follow it. We may do the very minimal activity. But the trick is, use the regulations to do the right thing. So I think my message is do the right thing. Do the right thing. And I think perhaps a combination of all of the things that we already have, plus the mandated identification of potentially fraudulent accounts that actually receive the money and mandated on banks essentially by December of this year, combination of all of the things plus all of the things that we do as an industry, I think that will have a bigger effect on this. My take on it, you can find many loopholes in all of the existing ecosystems, and it's always playing whack-a-mole, trying to actually plug those holes. We need to learn, and I think in our industry we don't learn fast enough in terms of communication of the benefits to what it is that we're trying to do. Hence the very slow uptake of open banking in the UK anyway. So, and you know, this has been going on since 2018. We still only have 7 million users, you know, when we last looked in February of this year. Because I think it stems from a lack of communication, and I think open banking has a branding problem, because it's been made more about data than it has been made of about payments. So suddenly when you hear the term open banking, it's just like, I don't want to open my bank. You know, if you're not in the industry. So it's been made about data, and now we're very, very conscious about data protection and data privacy. Suddenly we have these things where I'm going to share my information. Lack of communication, bad communication resulted in the situation we're in. Now it's improving. We have more and more users, but it's been slow. So what I wanted to say, really, it's a question of learning from the past. We don't learn fast enough. If you recall, when faster payment was first deployed, it was deployed by the UK government back in 2008 to boost the economy after the very big financial crisis. So it wasn't about innovation; it was about boosting the economy. And suddenly we have this new infrastructure. Payments can be made very, very fast. And we only had one innovation then, and that was payday lenders. Payday lenders suddenly enabled by faster payments. You can get money, you know, straight away. Now we know, and this is history, that there were many payday lenders, but it actually took 10 years to deploy regulations in that space. I mean, the rates became extortionate. People got into serious trouble with those companies, and they eventually all collapsed into administration, and they kind of don't exist anymore, more or less. So, but that's 10 years. So regulatory cycles are very, very long. So, which brings me neatly to, we're now talking about metaverse payment, new business model,
Exactly.
play as you earn.
So if we know where we did the mistakes in the past, and now with all of these new forms of money and digital currencies and metaverse and whatever is coming up, where can we learn from the past, and where do you see also like the major problems coming from? Because every change brings new issues which are then going to be resolved. But where do you see the main problematic coming from, at least at the very first?
At the very first, I can see that the industry is moving much, much faster than the regulations. Now, good news today, apparently the EU Parliament agreed on the new marketing crypto asset regulation. So overwhelmingly, so hopefully this should be deployed sometime next year, I guess. And there is a fundamental problem there, because essentially there is no international coordination whatsoever on anything related to decentralized systems in general. Of course, there are point initiatives such as, you know, the regulation of centralized exchanges, the regulation of stable coins, and the regulation of crypto assets that are related to securities, because that's already an area that's very, very regulated. But I think we really, really need to learn in terms of certainly communication, but also policy making. It's a tough job, because we want to, as a whole, promote innovation as well as making it a safe environment. And now you're seeing traditional players such as Visa enabling cross-platform payments. And this only happened last week, and this is a thing that I often ask the delegates in my courses, which is, Why is it that you can't pay someone using your PayPal account and they don't have a PayPal account, but they have a Venmo account? Why can't you pay someone via PayPal for it to land on your Venmo account? And lo and behold, this happened last week where Visa made an announcement. So we are becoming increasingly blunt in all of this. WorldPay is already offering settlement to merchant in USDC in the United States. Everybody's talking about offering infrastructure for CBDCs based on the existing network. So it's moving so fast, but the regulations are not catching up. And also we're not communicating to people. When I find at large, when I discuss these matters with people who have nothing to do with payments, the level of misconception is incredible. So and we still haven't learned. We didn't learn with faster payments. We didn't learn with open banking. We're still not learning. So it's kind of terrifying to see that we're rushing through all of this, not thinking about policy. And when I mean policy, I don't mean curbing the whole thing. I mean, let's create a safe environment for all of these things to happen, because the criminals are going to continue to be innovative. I mean, we keep seeing, hacks on DeFi services and so on and so forth, and incredible amounts of money being lost, where there are real business opportunities there in the digital world. So learning from the past, I would say, to protect the future is absolutely essential.
Absolutely agree with you, Neira. And well, you are in a good place to make your voice heard. So I'm sure that we will be doing all what we can to ensure collaboration between the Payment Association, the industry experts like yourself, and the regulators to make the payment safe more and more safe all the time, and in the new challenging system that we're going to end up. Fantastic, Neira. This is not the last one. We will have more with you because it's always insightful to speak with you. But thank you very much for your time.
You're most welcome. It's a pleasure.
Thank you. Thank you very much.